Hello and welcome to another episode of Darwin Investors. Ouch. So this is what it feels like to be investing right into the teeth of a recession. The NASDAQ just had its worst month since 2008, and that was a pretty great recession, they called it. I didn't think it was so great, but a great recession. You've got GDP that unexpectedly fell 1.4% last quarter, and that was due to a record trade imbalance that they say is actually going to lighten up in Q2 or Q3 of this year. I don't see that really happening unless the dollar weakens. The problem is that nobody can afford to import our stuff right now. A recession is kind of loosely defined as two straight quarters of declining GDP. And unless something happens with our trade imbalance, we'll probably get that. We're probably in the middle of a recession right now and just don't realize it yet. We'll see. Maybe we are, maybe we aren't. We've got layoffs happening over there at Wells Fargo in their mortgage department. We've got Amazon coming out with horrific earnings, talking about how their operating expenses are rising faster than their sales are rising. There's evidence that wage growth might be fading just a bit. So it seems like the ball's going back into the court of the employer at least for the time being here, because I think I can see that that unemployment rate's going to go up a little bit more than we've been accustomed to here recently. So if you've recently quit your job because Dunkin' Donuts doesn't want to unionize, or maybe you're trying to stand your ground because your boss is trying to make you come into work and you can no longer work from your bed with your boxer shorts on, you may want to start looking for another job soon. Again, it's advice. I'm not your dad here, but I'm just saying that if you've recently quit your job for reasons like that, maybe now's a good time to go out and look for another job before things get really bad. Also, into the teeth of all this, the Fed is looking at more tightening. They haven't said that they're not going to do that, and a lot more interest rate hikes that everybody's expecting. And that's another thing that the market is pricing in, is all these interest rate hikes. Do I really think they'll hike as much as people think? Probably not. I mean, the market's already crashing. What are they going to do? Just cause 1929 all over again? I don't see them crashing this stock market any worse. And it's doing a good job on its own without their help. So what am I doing? Well, I was paid yesterday and I'm investing, baby. So I just stuck more money in the stock market like I always do. Nothing's changed there. But how far do I think that the stock market can actually fall? Well, let me go ahead and share my screen and we'll get right into this. So Yardini has the S&P 500 large caps at a price to earnings ratio of about 18.2. It looks like at 16, we would say that it's pretty priced in. And at 16, here's 17, this is 18, excuse me, here. And right now, so Yardini has the S&P 500 here at 18.2. And at this level, we're about the level before the big Corona crash here. And we were here at about this level, and it looked like in about midway point of 2017 before that crash there. So it looks like we're still a little bit on the high side. Now, where does the market like to live? It looks like somewhere between 16 and 17 will work. We'll look at 16.5, we'll say. So how low can it get? Well, if I look at the SPY here, it's sitting at $412. So if we bring up our calculator and we say 412 and we divide that by 18.2, it gives us kind of like a metaphorical price per share of 22.63. Now, we said that 16.5 seemed pretty reasonable, so let's multiply that by 16.5, and that gives us an S&P of around 3735. So the S&P, according to this, worst case, kind of like worst case scenario, gets down around 3,700. So it could still fall another 400 points. Of course, it could fall a lot further, but I'm just saying, realistically speaking, 3,700 points. If it actually just falls to like a, say a PE of 17, so 412 divided by, that would give us an S&P of 3848. So it goes down about 350 points there. So that's realistically as far down as I think this thing can go. The NASDAQ can, of course, crash another 7, 8, 9, 10, 12%. I don't know. It can go down quite a bit. But right now, the S&P looks like it go down to about 38.48. So today's show topics are going to be how the retail investor has an advantage over institutions. And I'm going to show you that the system is actually rigged in our favor. Sounds ridiculous, and we always hear the other way around, but I'm telling you, it's rigged in our favor. We're going to do a quick comparison between growth stocks and value stocks, and this is the reason why things are rigged in our favor. And I'm going to do this demonstrating like the difference between Google and Union Pacific. And then finally, we're going to talk about Amazon and their earnings. And originally, I thought that they were just kind of a little bit corrupt because they tend not to really want to pay their corporate tax. So I thought that they fudged their numbers in order to get out of doing that. I'm beginning to change my mind. I didn't know whether they were corrupt or incompetent. And now I'm beginning to believe that they just might be incompetent. And unfortunately, I have a lot of money there. And that's the reason why I didn't want to invest in Amazon for the longest time, because I couldn't tell if they were corrupt or incompetent. But I'm beginning to think with their 20% share of Rivian, and the fact that they just have like too many warehouses now, they're just expanding just to avoid taxes. I'm convinced of that. Maybe it had something to do with COVID, and they were thinking that they needed to expand out, and this was going to last forever. And even that's incompetence. So I don't know. I'm beginning to think their leadership is incompetent. You know, they got their CEO blasting off into outer space. We got like having to tear down bridges so he can get a yacht down the harbor because they built it on the wrong side of the freaking bridge. I mean, this is an incompetent company. They got to fix things. And so what I'm going to do is I'm going to go over the importance of CEOs and CFOs. And I'm going to do that using UPS, Google, and Amazon as the barometers. Like we're going to compare what a good CEO, CFO looks like to Amazon. All right, I'm calm now. I just conjured up my inner Stephen A. Smith. I used to wonder how he gets so worked up talking about sports, but I guess I just got worked up like that talking about the incompetence of the Amazon leadership. So yeah, about the institutional versus retail investors. We actually have an advantage, and the reason why we have an advantage is we have this large time horizon that we can dial into. Versus like right now, the institutions are like, oh no, it's tech. You must sell. Get out of tech. You know, tech is bad. Is that tech? Oh, then you've got to sell that. And it doesn't matter what the valuation is of this tech. It's just tech bad. Everything else good, you know? And so that's kind of like the way that they're thinking. But we're going to show you that here in the long run, that's not exactly the right way to go. But in the short run, it is a good way to go because we don't have to answer these phone calls from people calling, say, Fidelity saying, how was my portfolio doing this quarter? And then we have to say, well, it's not doing so well. They aren't going to stand for that. Warren Buffett actually invests like a retail investor. He has a few large core positions. I want to say that Apple's something along the lines of like say 43% of his portfolio or something like that. And he's got large holdings in like Bank of America and that sort of thing. And then he rotates through these little sections, kind of trades through these little sections. And then he has a large cash position that he gets from like getting dividends from all of his larger positions like Bank of America and Apple. And Apple pays him a special dividend, I believe. And so he invests like a retail investor. Now, if he has a bad quarter, he can tell his investors that, you know what, I just had a bad quarter and but the next one would be better. And he's got a good enough track record that people go, okay, Warren, we believe you. Versus like the person on the other side of the phone at Fidelity, we're like, not necessarily, we don't necessarily believe you. So let's go ahead and I'm going to share my screen here and show you what I'm talking about here. So Microsoft here is down year to date 17.10%. Credit Suisse recently said, you should rotate into the utility sector. That's where you need to be next. And one company that they said that you should go into is Duke Energy Corp. And you can see that Duke Energy for the year is up 6.45%. Now here recently, the other sectors that people have that the institutions have rotated through would be like consumer staples. And a popular consumer staple might be Coca-Cola. And that one is up 8.95%. Healthcare has been another one that they've all gone through. And United Health would be a popular healthcare stock. It's up 1.25%. And a lot of people just feel like, you know, why bother with any of this? Let's just go ahead and go with the SPY and just go with that. And that one's down 13.76%. So they're avoiding the SPY. They're avoiding Microsoft at all costs. It's tech, by definition, means awful, overpriced. And that would work here year to date, and they could answer their phone and they would be, their investors would be very happy unless they took a large position in the SPY. But if you look over 5 years, what you'll find is that Microsoft is up 302%, Duke Energy is only up 32%, Coca-Cola is only up 47%, you'll find United Health is a dang nice stock, up 192%, and the SPY is up 71%. So those of us that think that just investing in the index fund and letting it ride is the best, it's not bad. Don't get me wrong. Over 5 years, 71% is a nice return, okay? That's a great return. But if you really want a great return, you pick the best stocks from the SPY and you invest in those. And a lot of those just happen to be tech. And this is the reason why retail investors have an advantage. Oh, and let's look at Warren Buffett. You know, he's got Apple. That's his baby. That's 43% of his portfolio. He's up 323% on that. And that's why Berkshire Hathaway does so well, is because he's able to invest the way we can invest. We're not handcuffed to these, I don't want to call them garbage stocks, but they're not as good as what you could invest in if you didn't have to answer that phone call every 3 months. And the next thing we're going to talk about is the difference between the growth stock and the value stock. And how is it that a value stock, like say Union Pacific, can go up year after year, given that there is no revenue growth in the company? And the reason they're able to do this is through stock buybacks. And because with stock buybacks, and they over the course of I would say like the last 13, 14 years have bought back about $40 billion in stock. And what that does is it takes their earnings per share and it makes their earnings per share larger. Now, Google grows at a ridiculous rate every year. We can see it's on the order of, say, 30%, about 20 to 30% every single year. Last year it grew, what is that? About 40% last year. And this year's comps are against last year's number when Google grew like something along the order of 40%. Their margins are unreal, 30% margins. So we have 30% margins, 20 to 30% growth. Last year was 40% growth. And then they just released this quarter where they make $68 billion and they just had 23% growth over a year ago. Now remember, last year they grew a ridiculous amount, and so it's reasonable to believe that even at 1% growth or even 5% growth, that would be okay, but they still grew 23%. Now, why is the growth stock important? Well, because the growth stock is important because a lot of these stocks trade off of valuation. And if you look at the valuation of Google at $110 a share, if it's growing at 20% a year, and I'm going to say 20% because because uh, they just grew 23%, and I'm going to lowball them. If they grow at 23 or 20% a year, that gives them an earnings per share of $132. At $132 with the current share price of $22.99 divided by 132, that would mean their new price to earnings ratio is only 17. Now remember, when we just did the Yardini thing, that the average price of the S&P 500 is 18.2. Now we have a company that has 23% year-on-year growth coming off of a year of 40% growth, that has 30% margins, trading at a PE that's a discount to the S&P 500. This is a fantastic company, and this is a company that institutions are running away from because it's tech. It makes no sense at all. It's not something you have to do. It's not something that I have to do. But I'm just trying to say that don't get out of Google just because institutions are getting out of Google. Let them go buy their garbage and come back to it in like 5 years and see who's the winner here. So let's talk about Amazon's quarter. Like I said, I didn't know whether they were corrupt or incompetent. And I think I have my answer now. So let me go ahead and share my screen. Amazon avoids more than $5 billion in corporate income tax reports, 6% tax rate on $35 billion of US income. And so when you look at this, in 2018, they paid negative 1.2% effective federal income tax on $10 billion of income. And again, it was 1.2, 9.4, and 6.1. So they do pay tax. Now, the mechanisms Amazon uses to achieve this are familiar. Tax credits account for 1.1% of the company's tax avoidance. And how are they avoiding these taxes? Well, the way that they do it is they use these totally legal tax breaks. They invest in research and development. They invest in property, plant, and equipment. So Amazon's investment in property, plant, and equipment also make it eligible for tax credits. So the bigger that they get and the more they expand, the less tax they have to pay. And they move away from paying people in cash and do it in stock-based compensation. And again, that drives more tax breaks. So this CFO seems to be quite good at avoiding taxes. That's his secret talent here. And if you look at Amazon over the past year, what was that, year or quarter, 12 months, and over the past year, they sold $2.6 billion worth of their stock. So they're diluting our shareholders as well. Just to keep it unprofitable this past quarter, they had to dilute shareholders. And so if you look at Google just announced that they were going to buy back $70 billion worth of their own stock. I'm not even sure Alaska cost $70 billion. Or Louisiana Purchase. I don't even know the Louisiana Purchase was $70 billion. But Google is buying back $70 billion of its own shares this year. And that is what a great CFO can do for you. Now, who is their CFO over there at Google? Well, their CFO is this Ruth Porat, and she's a British American business exec. She was the CFO and executive vice president at Morgan Stanley. She began her career at Morgan Stanley. Before becoming the CFO, she served as vice chairman of investment banking from 2003 to 2009 and the global head of the Financial Institutions Group from September 6th to December 2009. She knows what she's doing. It's one of the reasons why Google is so good. Now let's go ahead and look at UPS. What did UPS get? Well, they hired Carol Tomé. Carol Tomei is an American business executive, is currently the CEO of UPS. She is formerly of Home Depot, where she worked from 1995 to 2019. 26 years she worked there, serving as the vice president and treasurer, and later as the executive vice president and chief financial officer at Home Depot. And let's go ahead and have a look and see how is UPS doing since she arrived here in 2020. Well, if you look at UPS and their statements, now, granted, 21 was a banner year. Okay, it was e-commerce was flying, but their growth, it jumped that year. You expect that, but here's what you expect from a great CFO. The margins, the profit margins went way up. Here they were about 8, maybe 8%, maybe 9%, and now they're closer to 13% because she knows what she's doing. And that is what Amazon needs to do. And let me help you, Amazon, just to show you that I got your back. I did a quick Google search, and this is all you got to do. You go out to Google and you Google who is the chief financial officer over at Bank of America. Then you go over here to this guy, Alistair Borthwick, and then you ask him what his salary is, and then you offer him double, and he'll come over and fix your stuff. And if you can't get him, then you go over here to the Wells Fargo, and because they just had a turnaround, and that's a good company turnaround. You ask about this guy, Michael Santamassimo, and you say, hey, how much are you making, Michael? Or can I call you Mike, buddy? And then you go ahead and offer him double, and he'll come over and fix your company. Because right now, things aren't working for you guys. All right, that was my rant for this weekend. If you got out of this video, yeah, please go ahead and like, subscribe, hit the little notification bell. And until then, we'll see you next time. And I'll be more positive. All right, have a good day. Bye.